Let's discuss the unusual and infrequent gains and losses, the major categories of items that would be reported this way in the non-operating section. As we can see, there's a lot listed here. So let's write them out one at a time, because we do need to remember that each one of these items here is reported as an unusual and infrequent gain and loss. Why do these items have separate disclosure on that income statement? Well, if investors are using the income statement to help predict future earnings, what sort of weight would you put on something that reduces income or perhaps increases income, but is unlikely to happen anytime soon in the future? You'd probably put less weight on it than you would, let's say, an operating gain or an operating loss. These are the items that are considered unusual and infrequent. 1, restructuring charges. We're going to go through each one of these items in more detail below. 2, losses on the write-downs of assets. So when we record a journal entry to take down the value of an asset, we call that a write-down, and sometimes we call it an impairment, but they mean the same thing. Taking down the value of an asset. So losses on the write-downs of certain assets. What might decrease in value, the market value become lower than what we have reported on the books? Well, our receivables, accounts receivable and notes receivables. What could cause that? Major economic decline could cause people to have less money and be less likely to pay off their amounts owed. Inventory. There's inventory that becomes obsolete and is no longer able to be sold or not sold for an amount above cost. That inventory needs to be written down. Plant, property, and equipment. There's a major decline in real estate values or in the values of equipment. We need to write down or impair the asset values, and also intangible assets. And we'll talk much more about impairments of PP&E and intangible assets, such as goodwill. So for an example, goodwill or patents and trademarks. We'll talk about these intangible assets as well as how do we test for impairment, what would that journal entry look like, much later in the semester. For now, we need to know that as long as these items are happening, not too often, they would show up in that non-operating section. What else? Well, a company can have gains and losses from various items. One of these items is sales of land, buildings, equipment, or in other words, sales of PP&E. Right? Companies are not in the business of selling their own lands, buildings, or equipment. They're using that stuff for long periods of time to run its business. But once it does sell it, that's non-operating because it's not what the company's in business of doing. What else might a company sell? Investment securities. Because companies invest in stocks and bonds just like the rest of us when they have excess cash and they want to earn a return. Either a gain or a loss could result from these sales, depending on how the market value or the cash received for the asset compares to what that asset's value is on the balance sheet or the asset's book value. Gains and losses can result from what's called the extinguishment of debt, early repayment of debt. And gains and losses can result from casualties, such as primarily acts of God or acts of nature, fires, floods, earthquakes, major storm damages, and other catastrophic events that could have a major impact on a company. Impacts of a strike or any other major unexpected loss that happens to a company. Now let's take a look at a few of these items in closer detail. Restructuring charges. Restructuring charges are the costs that a company incurs when it has a major reorganization, closing down the corporate headquarters and moving those corporate headquarters to another state, perhaps a state with a lower tax bracket, and that old corporate headquarters becomes, I don't know, maybe a university. That organization that moved its headquarters is going to incur major costs. Cost to pay severance to the laid off employees, relocation costs to the employees that did relocate to the new location. We can see here a recent article in the Journal of Accountancy states that Macy's, following the decline in business with COVID-19, is planning to lay off 3,900 corporate and management employees. And with that, with those layoffs and presumably severance packages, it expects a $180 million charge in restructuring. Why is it doing that? To save on all of the future salaries that it would have had to pay otherwise. Write-downs and impairments. An impairment, also known as a write-down, is a journal entry that's recorded when something happens outside of the company, typically, and an asset becomes worth less than what it's reported at on the books. So here's an example from a recent news story. Delta announced a decision to retire or get rid of some of its aircraft. And in doing so, it has to take a $2.5 billion charge. Why? Well, that aircraft is not going to be able to bring in revenues. It's not going to be able to be used to run flights. So what do the accountants do? Well, somehow they got a value, a market value, or some good estimate of the future cash flows that that aircraft could bring in. Let's say it decided it was $26 billion. But on the books, that aircraft had a value of $28.5 billion. So if they're going to eliminate that, you can sell them for $26 billion, take them off the books for $2.5 billion. That difference must get reported as an impairment expense. And as long as this is not happening too frequently, that impairment expense is going to be reported on the income statement in that non-operating section. Other assets, again, that can be written down or impaired: accounts receivable, inventory, plant, property, and equipment, and intangible assets. Let's talk about the difference again between gains and losses. Gains result when an asset is sold for more than its book value, and losses are exactly the opposite. What types of assets might be sold for a gain or a loss? We're not talking about selling inventory at a gain. That's normal business operations. That's sales revenue. And with the cost, when you account for the cost of that inventory, it's cost of goods sold. We're talking about a company that sells its buildings, its equipment, its lands. These are not typical activities that take place. Companies that sell its investment securities, such as shares of another company's stock or bonds in another company or organization. Gains and losses on extinguishment of debt is one item that we wrote down. If a company decides to repay its debt early, this typically happens when interest rates fall and a company wants to take advantage of these lower interest rates. It will pay off its existing debt so as to go out into the market and probably get new cash at a lower interest rate, take that cash and pay down its debt. With that repayment, there might be a gain or loss. We don't need to know how to calculate it at this point in time. We just need to know that gains and losses on extinguishment of debt are non-operating. Gains and losses related to casualties such as fires, floods, and earthquake. You might be wondering, how could a gain result from a fire, flood, or earthquake? That's if our insurance proceeds are greater than the damage that was caused. Here again, we see the multi-step income statement with the line for other revenues and gains, other expenses and losses. And now we have an idea of what types of items might be behind those numbers. Again, why distinguish between operating revenues and non-operating revenues and gains? Because one relates to the company's primary objective, primary activities, and is more likely to be correlated with future revenues. Why do we care about operating expenses versus non-operating expenses? Operating expenses are more likely to be associated with future operating expenses compared to non-operating expenses and losses. And so here we see the remainder of our income statement. Let's finish up our notes with the remaining portion of the income statement.